Welcome to the NZ Everyday Investor. I'm Darcy Angara, and I'm joined in the studio by Amanda Martin. Thank you, Amanda.
Hi, Darcy. Thank you for having me.
Thanks for coming. So today we are talking about the devil in the detail around capital gains tax.
That's right.
It's exciting, isn't it?
It's very exciting.
More
yes.
so for you probably than me, because this is kind of your gig. But
Yeah.
I'm really excited to have someone like you in the studio because whilst I've known you for probably just over a year, I guess, I never really appreciated that what you do is probably incredibly relevant with what's happening right now around capital gains tax and the proposed capital gains tax as at the time of recording.
That's right. Well, we've just had the tax working group report being released. So, capital gains tax is on the tip of everyone's lips at the moment.
Yeah.
In my work, we're just trying to digest it and really think about all the possible permutations and outcomes and how it can affect people going forward.
And it seems
if
like,
it comes in. And
that's right,
the big question.
The big F, capital F. But it seems like, I know that just picking up stuff in the media, there's this sensationalism to start with, like with anything new and a little bit controversial. There's a little bit of sensationalism to start with, a couple of media sound bites, but then as time goes on, it settles down and there's a bit more of a rational debate that can occur, a bit more facts that come to the surface, and then there's a little bit more, I guess, meaningful dialogue that can occur about it.
That's right.
It seems like we're at that stage now, isn't it?
People are we're now starting to go through the detail of the report and seeing what is being proposed. It is interesting that the way the group actually reported back that 3 of the group were not in favour of a comprehensive capital gains tax. Those members, one was from the business community, one was a tax lawyer, and one was Robin Oliver, is also the past Deputy Commissioner of the Inland Revenue Department.
Wow.
And it's really interesting,
interesting.
for them to say, well, hold on a minute, let's just pause there.
Right.
We can see the case for capital gains tax to be applied to residential rental properties and residential property. But really, we should just take a much more managed approach because the compliance costs are huge and there could be effect on capital markets and various other matters. So it's not a done deal, and I think people have been listening to Robin Oliver. He's been out in the media quite a bit since the release of the report.
Right, okay. So I guess that's one of those things where that's the beauty of being in New Zealand, right? Is that even though there's this tax working group, which correct me if I'm wrong, but that was put together by the government. It was initiated by the government, but it isn't the government. So we didn't really vote for these people to make these decisions and these recommendations, did we?
No, we didn't. They were put together. It was a broad sort of cross section of the community.
Okay.
Led obviously by Michael Cullen. So, and the group put out the interim report, flagging up a couple of options, but there seemed to be a clear indicator that they were looking and going to go in favour of a capital gains tax.
Okay.
And then the final report's been released, and sure enough, it's pro-capital gains tax.
Yeah.
And obviously now the big thing is for the government, they're now Labor is now talking to its coalition partners to see what's in, what's out.
Yeah.
And
It's clever politics, though, isn't it?
Yeah.
Because it wasn't my idea.
It
was just this guy that I contracted. He said it was a good idea.
Well, I suppose you've still got Jacinda's captain's call that was made prior to the last election. So we sort of know where the Labor Labor-led government is going.
Yeah.
But it's really just going to see what deal they can cut, because the way the proposals will come in, the intention is for the legislation to be passed and go through its full consultative process and then be implemented and effective from the 1st of April 2021. So everyone at the next election will know what they're voting for.
So we'll be voting for this at the next election, and between now and when we're voting, this is the time to actually get clued up as to what it all means.
Yeah, essentially. But from what we understand, the legislation will pass and be up for appeal.
Okay.
So we know what we're getting come 1 April 2021.
Okay, that's good. Yeah, and I was trying to read this report last night. It's not a good idea, really. At 9 o'clock at night.
It either puts you to sleep or gets you really excited.
Yeah, well, to me, it kind of made me want to slit my own throat, to be honest. But it was kind of like, wow. But it was actually fairly well written. And I do kind of understand the rationale behind it. Yeah, I had like we all do, I had my preconceived notions and I had my own biases that came to that page when I was reading it. But I could honestly see that there is some logic here. It does make sense, and I do understand this, but it is still hard when it affects you more than you know that it affects somebody else.
Absolutely, and it will affect a lot of the baby boomers. It will affect a lot of people who've made investments and are saving for their retirement through a variety of means. In terms of it, it's going to hit them in the pocket eventually.
Yeah, and I guess when it comes to actually, if you wind the clock back for some of these people, they would have planned on having a certain nest egg on their 65th birthday to get them through their retirement. But now potentially there needs to be some more maths done and some more risk taken to offset the fact that the government needs to take a larger share of that.
Yeah, absolutely.
And they didn't have that information before when they started off on this path.
Absolutely. Okay. And I suppose the other side of it is that social justice, equity line of argument as well, which we can't ignore.
No, that's right. And let's define what capital gains tax is first. So go, your turn.
Right, okay. So we have income. So we've got income either in the form of income from our personal exertion, our interest that we might derive on our bank accounts, our dividends that we derive from our shares that we own, and that is the income. I like the fruit from the tree, and the capital is the equity, the capital of those.
I like
assets.
that analogy.
Yeah, the fruit, the tree. It's we throw that around in the tax.
Do you in the tax world?
About the tree and the fruit.
Look at that.
And
tax people are actually into trees and fruit. So I guess the wood is the capital gain as it grows over the years.
Yeah, the wood and the wood like and the tree bears the fruit.
Nice. That is very beautiful.
And at the moment in New Zealand, typically we tax the fruit and we don't tax the growing tree.
Gotcha.
Within the Tax Act, there are sometimes that we do tax that tree.
So if you're a logger, if you're raising a whole forest of trees to log.
Exactly, or if you buy something with the intention of resale,
with
the purpose or intention of resale, we'll tax that. So, if I say, Darcy, I'm going to go and buy that property, I'm going to flip it in a year's time, I'm taxed on it.
Correct.
And this is before those bright line rules came in.
That's right, and that's always been there.
So, and even when we're talking in the context of land, there are lots of ways in which we already tax land. Dealers, developers, builders, people that do major subdivisions, we actually already tax that. So I get a little frustrated when you hear people throwing out, there's no capital gains tax. Well, yes, there's not, but there's a lot of instances where the sale of a capital asset actually gives rise to income.
Perfect. Well said. So if in the course of your business or in that business type activity, you're actually using that as stock and you're buying it at a lower price and then selling it just like any other stock, just because it's land doesn't mean it's exempt, you're still going to be taxed on the gains.
That's right. And that's what this report does reiterate, that your trading stock, your revenue account property, that's going to be still subject to tax and those existing rules will still apply.
Okay. So then to define capital gains tax as it's been proposed in the context of this tax working group's paper, that is actually kind of throwing the capital gains into the same pot as all the other income, right?
That's right. And so they're proposing to bring in those types of income and losses that we're not currently recognising as effectively ordinary income.
Right.
And the intention is that it will be taxed at your marginal rate. So it's just effectively thrown into the pot.
Right.
There'll be some rules around ring fencing of losses and making sure that you're not manipulating the rules.
Yeah.
But the basic premise is that all of that type of income, other than a few excluded assets.
Okay, and we'll come back to that one. Yeah, because I guess there's going to be a lot of distortions. There's going to be a lot of exceptions. There's going to be a lot of work for people like you to be able to, if this gets implemented. But the core issue here is that, especially when you look at overseas, as it's been proposed at the moment, it's going to be accruing in the year that you receive that income, right?
That's right.
So if you if you realize a gain of say $350,000 by selling a property that you've owned for 20 years, then that's going to be a $350,000 increase to your income for that year. And in some cases, that'll push you in a higher tax bracket as well.
Possibly, yes.
Yeah, okay.
And the IRD will need to, when they're working through drafting the legislation, and this is coming back to your comment about the devil in the detail, we'll need to really carefully think through, does it affect provisional tax? Are you then going to get a use of money interest bill? So there'll need to be specific rules around, possible one-off transactions that you hadn't anticipated.
Gotcha.
So how could you have...
it's interesting, isn't it?
Timed it. So it's all as this detail filters down that we really need to think.
Yeah.
This is a huge undertaking.
Yeah.
If a comprehensive capital gains tax comes in, it's going to involve, I believe, a significant rewrite of the current tax law, which, if you've ever seen it, is enormous.
I'm sure
very
you've seen
complicated.
You look like somebody who's seen it, I believe, by looking in your eyes. You've seen that? So I guess if we were talking to a self-employed person who has grown their business out of nothing, they know what it's like to deal with tax, because they would have had to reach a point where they're now in a situation where it makes sense to actually form a limited liability company. They've possibly gone into the GST zone. They've hit that zone where they need to start worrying about provisional tax, maybe fringe benefit tax, getting a tax plan together and dealing with irregular income. There's challenges around that. So they'll know, probably more so than a PAYE earner, for example, they'll know how complexity around tax can affect them personally. That's
right. And cash flow.
And cash, yeah.
Cash flow is king.
So if you look at, I guess, the bulk of ordinary, and I use that term very liberally, but let's just say, if we look at the bulk of PAYE earners, people who have never had to be self-employed, I don't want to make this sound like they're not smart enough or good enough in any way. In fact, they're blessed because they don't have to deal with all this rubbish that you have to deal with when you're self-employed. But this could be a massive undertaking for people who have had a fairly, simplistic experience with tax, right?
That's right. So in terms of any assets that are going to be brought into the capital gains tax, and they dispose of those assets, or there's a change of use, which is then a deemed disposal, or they may move overseas, for example.
Correct.
Then we need to start planning out to make sure, have we got the cash flow? That's for right. One, have we planned it, and making sure that, come that implementation date, are all our ducks in a row.
Correct.
In terms of a PAYE, a person who derives PAYE income, they'll see an effect on their KiwiSaver account. Yeah. So there is an indication that there'll be a change in the way that those savings funds are going to be taxed.
Nobody's going to get out of this alive.
No one's going to get out of this alive. There will be some rollover provisions. There's mention of relationship property transfers. So, when you go through a divorce, right. There's a rollover provision which already applies. Right. There's rollover provisions which apply when you have inherited property passing through. Sure. Right. But actually, it looks like it could only be in very specific circumstances. Right. So people that have trusts and estate planning, people are going to have another look at their trust deeds and just plan out exactly how they're intending assets and distributions to be made from their trusts.
So am I correct in, I guess, making a statement that what Xero, the online accounting platform, has taken away from accountants, the IRD will bring us back in terms of workload for accountants?
It's going to be significant, the compliance costs, no matter what. So, and actually, if you're in the valuations business,
that's right.
That's going to be huge.
Well, interestingly, you mentioned that because I know of a few valuers in the last, say, 3 to 4 years in particular, who their business volumes have gone down significantly due to something that's happened in the banking community where there's more of a centralized service for ordering valuers, and you can't engage valuers directly. You have to go through this centralized system. And some valuers have really suffered as a result of that, I guess. But now you've got a need for, I guess the onus will be on the everyday person to prove what that value was. In 2021?
That's right. So what the proposal is that the rules, when they come in, will be effective on valuation date, which is 1 April 2021.
Sure. This will capture everything.
That's right. And the way the report is worded is that they're going to give you a 5-year window to get that valuation, unless you sell your assets sooner.
Gotcha.
So it's still an enormous compliance cost. And the report is quite clear saying that the Inland Revenue Department needs to have some readily available calculators and databases because it's so much work.
Right. And there'll be a lot of, dare I say, there'll be a lot of people kind of not disputing, but entering into dialogue as well, querying things. And
absolutely.
That's just really going to...
Well, you're really going to want as high value as possible for any of your assets.
So I was on, I was calling the IRD maybe 3 weeks ago.
Did you get through to them?
2 hours. 2 hours with a very interesting callback system where if you're in an office and you have 3 options of who to go through, it was interesting. So I'm just thinking, what's this going to look and feel like for the everyday Kiwi who needs to call the IRD to query this or challenge this? Is this just going to be an absolute nightmare?
Well, it's going to be really hard. Absolutely. And the department is going to have to put a lot of resources in there, and just in terms of where you're at the moment with your 2-hour experience. So the Inland Revenue Department is currently going through a transformation project, and they've got 3 or 4 big projects on the go. A lot of people have been reassigned to different projects within the department.
Right.
So it's actually very difficult to get through and anything done at the moment. Right. Then we layer on top of that a whole new lot of law. It's a huge amount of work.
Okay.
And from what we understand, also the tax policy group who will be assisting with writing this legislation, they've still got to go through a restructuring. So, and there's been quite a few people leave recently. So just as a resource point of view, it's going to be really hard because, any law has to go through its 3 readings, select committee stage, and everyone's going to be having their 5 cents worth.
Sure.
And then to come out with good law.
Sure. Which actually works in
reality.
reality.
Which works is hard. We've currently got a bill before Parliament at the moment, which was tabled in December, and it's due to go back it's in select committee at the moment, and it contains those loss ring fencing rules.
Yeah, let's touch on that actually, if that's okay, Amanda, because I'm quite keen to make sure. We have covered this last year. I can't remember the episode number, but I'll put it on the show notes. It was with Carl Morton,
right.
And we talked about this. And at that stage, it was very much a proposed change. But as time has gone on, I think the general consensus is that it's going to happen.
Absolutely. Well, it will happen.
Yeah.
So, and really, the usefulness of it, once capital gains tax comes in, it might well be repealed.
Wow.
But we may not need the
Sure.
the loss ring fencing afterwards.
Correct.
But so the way these loss ring fencing rules are coming in, so they're currently at select committee stage, so we don't even have final legislation yet. They're proposed to be effective from the 1st of April 2019. So you've got 2 weeks
Right.
to
buy up as much stuff as you can for your investment
Well, I was
property.
going to say, do all your repairs and maintenance
Yeah.
now, any
Yeah.
deductions now, if you're affected by loss ring fencing.
Yeah.
So, and your listeners will be aware with
Well,
what it
maybe
is.
we should just quickly define what that is,
Yeah, sure.
because I know for me, to give you an example, we've got a couple of rental properties, and I've got my trailer ready to go, hooked up outside my house, ready to go down to Bunnings to buy a whole bunch of insulation, because I got to get that job done for another reason. But I'm doing it now. I'm buying everything I possibly can right now because I know that there'll be a slight tax rebate that will come to me because I'm making a loss on paper on this rental property, this business that I've got.
Yeah.
So that's my version of it. But in your world,
that's
what's
pretty much right. So effectively now, when you own a rental property, often in Auckland and other parts of the country, they operate at a loss by virtue of either your interest exceeding your net rental and other costs, but also it could be that you just go through a bit of a R&M program.
That's right. Repairs,
and
maintenance, rates,
quite often
insurance.
it's lumpy. Sometimes you've got to fix things.
Yeah.
So
Or you have a
for
vacancy.
for whatever reason, that income, whether it's you own it in your personal name or you might own it through another entity like a company, which is a look-through company, so it's transparent for tax purposes, that gets then attributed to you. You combine it all with your income, and because you've paid your more taxes than are owing by virtue of having your tax deducted through PAYE or other sources, you then get a tax refund.
So you're not double taxed.
So you're not double taxed. Well, you've got a loss, you've got income, you bang them together, it's a lower amount, but you've paid more tax up front, so you get a tax refund. So what these rules are going to do when they come in is ring fence those losses. So you'll be able to carry those losses forward, but and offset them against
future profit.
Future profit, and there are mechanisms for if you dispose of the property at what point you can recognise those losses.
Sure.
But these, you won't be able to get that immediate cash
Gotcha.
refund.
So currently, if there's a loss in that type of income, that property-related income, it can offset your personal income tax liability immediately. But in the new world, if these proposed changes go ahead, which look like it's almost a guaranteed
It's a done deal, really.
Then it could offset future taxable income in the future. So, for example, if you're making a loss for the first 5 to 10 years of ownership of a new rental property, it gets contained and built up, and then it will offset subsequent years that you're making a profit on that.
That's right.
Gotcha. What about with capital gains tax then? If there were two things happening at the same time, could a loss offset that liability?
The intimation by the report is they'll need to look at whether they keep the loss ring fencing rules. In the same way that, do we need to keep the bright line rules?
Of course, because this effectively this is the real deal.
Yeah,
do we need a shadow of what that is?
Who knows? And the three working group members that dissented said, well, why don't we just extend out the bright line rule?
Well, let's talk about that, because there's the ring fencing bit, and then there's the bright line extension bit. And a lot of people, to be honest, might not even know about what the bright line test means.
Huh.
So if...
Do you want me to give you a quick...
give me the lightning version of what that definition is.
So these rules came out in 2015. And if you buy a residential land that is disposed of within the bright line period, and so until the end of March last year, it was 2 years. Now it's 5 years. And you dispose of your property within that period of time, it's subject to tax.
Sure. Okay.
And under these bright line rules. Now, there's very specific rules on acquisition dates, disposal dates, which set of rules you're in. Are you in the 2 year? Are you in the 5 year?
Yeah.
And there's some exemptions. So it won't apply for inheritance property. Rollover provisions apply for relationship property transfers. So that's if it's under a relationship agreement. And again, it's very specific whether you're in those rules or not.
Okay.
And also if you qualify for the main home exemption.
Gotcha. Which puts most people at ease right away.
Yeah, in terms of their personal home. So if for more than 50% of the time that you own the property, you've used it as your main home, the bright line rule won't apply.
And then, but if it is, and this is one of those things where I think a lot of Kiwis have done this, if there's this small subset of people who have constantly bought and sold the property that they live in, at some stage they're going to be picked up anyway.
Oh, absolutely. Well, there's already a rule where you can only use it a certain number of times in the preceding 2 years. And also you start looking like you're a habitual
That's right.
mover and a renovator and seller.
So this was extended to 5 years, roughly this time last year, without not a lot of discussion, I might add. From my perspective, I wasn't aware of it until I spoke to my accountant about it.
Well, it was just slipped in.
It was just slipped in.
It was literally just slipped in.
Something like this not be just slipped in? I'm just sounding this out.
Well, I suppose that the government had flagged up, we're going to extend out
so it was
bright line to 5 years, but they did just slip it in, and they chose this ridiculous date of the 29th of March. 2018. Why they didn't choose 1st of April, that would have been a whole lot easier.
Maybe they were just in a hurry. They got things to do that day.
Someone needs to do something. So, but from a tax planning point of view, suddenly 5 years is a lot longer than, people can handle 2 years being locked into something, but 5 years.
Most people can't think beyond.
And also just remember those rules. There's no concession at all for, restructuring. Say you want to bring in a new investor. Say there's a commercial risk. Say something, untowards happens and you just have to sell something. Change of circumstances.
Yeah. Or for whatever reason, the trust that owns it needs to dispose of it because it's not the correct ownership vehicle. You move it into an LTC, you're going to get pinged.
So there is really very little wiggle room we've got anymore.
Right.
And so people just should be very careful about moving properties around.
So the reason why I just wanted to kind of hone in on that whole slipping in bit was because it feels to me that it's a significant thing to put out there, and the effects of that haven't yet been seen.
No, they haven't, although we are just starting to see a lot of bright line income coming in, and we will absolutely be in the thick of it with these loss ring fencing rules coming in as well. When and if it comes in.
That's right, when and if. So let's talk about that then. So what is the actual likelihood that the capital gains tax, as it's been proposed in its current format, what's the likelihood that it will actually go through like that?
My gut feeling, I think the government has already indicated they're wiggling back from a full comprehensive capital gains tax regime. It's really going to be, we'll know in April, actually, where they stand on it. Because remember, it's not just property, it's shares. So at the moment, can I talk a little bit just about how we tax New Zealand and Australian equities?
Yes, because that's not necessarily equitable.
Well, exactly. So at the moment, you own your shares in Mercury Energy, you're taxed on the dividends, but if there's a capital gain or loss, we don't tax that gain or that loss. So you're just taxed on the income, the fruit from the tree.
That's right.
Under the proposals, those assets will come into capital gains tax. So we will be taxed on the dividends and also we will be taxed on the capital movement.
Gotcha. So you sell those shares at a gain, you'll be taxed on that gain as well as the dividends that you've already received.
So this applies to the tax treatment for New Zealand equities and Australian listed equities. So for global shares, they're currently taxed under what we call the foreign investment fund rules. And so there's a number of methods, but most people will see their report from their fund manager come back and it's this fair dividend rate method called the FDR method or the comparative value method, which is a market value movement method.
That's right, yeah.
So the working group report is saying, well, actually, we're going to leave that as is. And the way the fair dividend rate method works is you're taxed on 5% of the opening market value of your share portfolio.
Yeah.
And they say, and when those rules came in, it was actually tried to replace the fact that it was to represent the dividend stream. And the argument at the time was, well, actually, global equities don't really return enough.
That's right. They kind of just grow in value.
So we'll just take a 5% and we'll tax that, and that's akin to being taxed on the dividends.
A bit of a workaround.
A bit of a workaround. Yeah. So the working group is proposing just to leave that as is. So we've got a clear mismatch in treatment between how we tax New Zealand and Australian equities versus global equities.
Gotcha.
And, the nsaTax and all your fund managers are getting up in arms, or they should be,
that's
about
right.
This is a fundamental change.
So now there's an incentive for us to invest outside of Australasia because it just disincentivizes the hell out of investing in New Zealand shares.
Absolutely, it does. And remember, your overseas investors are probably already taxed on any capital gains, so they don't really care. They don't really care. They'll pay tax in New Zealand and they'll claim a foreign tax credit over in their in their home jurisdiction.
Do you think that this would have actually been thought about when they made this proposal? Would they have gone to that level of detail?
From memory, I just have a recollection of almost the global equities piece being put in the too hard basket. In terms of...
With 11 people, how could anything be put in a too hard basket? These are really smart people.
In terms of the reporting requirements, for those that were around when this fair dividend rate came in, it was a huge systems undertaking.
Right.
And if anyone has... any accountants out there that actually have to deal with these reports, they're only as good as your client having one portfolio with one fund manager. Because as soon as, of course, you have two portfolios with different fund managers, you have to sort of dissect them and rework them to arrive at a number which might come out to zero.
And you wonder why you're paying your accountant so much and you don't really see the benefit. It's just because of this.
Oh, exactly. And this is the big, I suppose, my concern is that there's going to be a huge amount of compliance cost.
Correct.
And that's what the three that dissented acknowledged was this is a huge amount of work and a huge compliance cost.
So the pragmatist in the group.
Yeah. And just coming back to the compliance cost point, just on those loss ring fencing rules, the way they're currently drafted, everyone has to apply them to even figure out if they're out of the rules. So there's a lot of work that needs to be done on that law before it's passed. And it's almost like two people were sitting in a room and not talking to each other when they drafted that legislation.
Right.
So there's people need to be aware that there could be quite a lot of additional cost for very little benefit.
Okay. So at this point, I think it's probably appropriate just to point out the fact that we're, as best as possible, we're both trying to be kind of in the middle here in terms of not being or at least not stating whether we're for or against it. But I know from my perspective, I'm still learning, so it's going to be way too early for me to pass judgment. I think from a macro perspective, from a social justice perspective, yeah, I get it. I totally get it. There's a very small percentage of our population in New Zealand that, for lack of a better term, there's a sense of hoarding. You know, there's a bit of wealth, and if you subscribe to a bit of a scarcity mentality, which I'm not even going to go there, but if they have it at the expense of you not having it, I get it.
Absolutely.
Because there's people trying to rise up here. There's people that are trying to build wealth and get on the same level playing field and have a fair shot at things. And if there are others that are getting in the way of that, then yeah, let's totally try to dismantle that. But on the other side, I'm thinking, just because somebody over here has it, it doesn't necessarily mean that somebody else has the right to take it away. Were they just lucky? Did they not take risk? Sure, there's those people that do have the batch in Omaha that probably just inherited it. But there's all of these thoughts that are also going ahead, around in my head, and I'm just wondering, why is it that we're actually doing this? Why are we doing this? Is it because it's really important to address inequality and it's an effective way to do it? Or is there just a little bit of truth around this envy tax statement? What's your thoughts on that?
I think absolutely. There's lots of ways we can look at this. New Zealand is unusual in that we don't have a capital gains tax regime. Overseas jurisdictions, most do, and many of them have it at a lower rate. Many of them have a lot of concessions and rollovers, so that if you reinvest in a similar asset or a similar business, that it's deferred. Yeah. So we are unusual in that we don't have a comprehensive capital gains tax regime. Yeah. And I can totally appreciate the social justice aspect of it as well. Yeah. As a tax advisor, it would be good.
That's
but I just see there'll be a lot of additional cost that's really not required.
And New Zealand is unique, right?
And New Zealand is unique. I think we could introduce it in a measured way. Yeah. Is my personal view.
Okay. And it does, again, going back to the report, if you read the report, and you do get a sense for some of the logic underneath this.
Absolutely.
So definitely not
and
disputing
they have been quite
logic.
well balanced in acknowledging the differing views and the the pros and the cons.
Yeah.
And they haven't put it out there that the government needs to adopt all of the recommendations.
Yeah. Yeah, which is good. It kind of makes sense.
It'll be interesting to see, though, how New Zealand First comes to it.
Yeah.
And, particularly in relation to farms and lifestyle blocks.
Yeah.
The excluded assets. So the assets that are not going to be subject to capital gains tax are the excluded home, so your main home, and your personal assets, your boats and artworks and personal effects.
Well, of course, because they always usually go down in value anyway. So
indeed they do.
we get a claim
unless you're sitting
credit.
on a hotary without realising it.
Yeah.
So, that'll be the conversation they'll be having at the moment. They've talked about, what is the excluded home? It's the home and the land under it, and they've talked about it going up to 4,500 square metres, and that's a little bit of or the land that's required for the personal use and enjoyment of the home.
Right. So do you want to take me through that again? Sorry, just
so they're saying, say for example, you've got a lifestyle block.
Yeah.
They say, well, the amount of land, the house and the land up to 4,500 square metres, or the amount of land that you use as part of the enjoyment of the house, so the house and curtilage, effectively. So that will be the part of the excluded house. So the balance.
Right. Yeah. So I have a 5,000 square meter property, right?
Right.
So
okay.
you're saying
so it's kind of saying, well,
potentially
500 metres could be subject to capital gains tax.
Okay. Right.
So
that makes total sense.
I know. So there'll be a whole lot of conversation about, is that appropriate or not? That number, 4,500 square metres, that's really been plucked out of the existing residential exclusions, which are in the land provisions at the moment.
Okay.
So there'll be some discussion about that.
Our place was subdivided in a time where that was the number.
That was the number.
So
exactly. So there'll be kind of work around that, but it'll start affecting people when, for example, they run a home office.
Yeah.
So, there'll probably be lots of your listeners here that might have a home office, they run a consulting business, and they might claim a percentage of the costs. Well, the way this report reads, if you claim the costs, you're bringing, say, for 10-15% of your rates, insurance, those sorts of mortgage payments, etc. You are bringing in 10% of your house.
Right, as subject to capital gains tax.
That's right. Now, if you use it for less than 50%, they're saying, well, or you can opt to not claim the costs and elect to treat it as your. So, there are people who need to make some decisions about it. But, the last thing you want to be doing is claiming costs and inadvertently realising, oh, no.
That's right. Yeah.
Now part of my house is subject to tax, which
That's right.
could have
So
been
would this
otherwise.
also apply, Amanda, for those that own a home and income property? And again, they're claiming a portion of the interest, the R&M, the rates, the insurance, because they have $300 a week coming in as rental income.
Yes, that's right. So if you're claiming those costs, so if you don't want it to apply, you return the income, you return the $300, but you don't claim any of the costs.
Right. Okay.
So,
it kind of makes sense.
people are going to have to be working their numbers when they're looking at potential investments as to
correct
as to how the numbers flow out.
So enter in this term, the Mansion effect. And
yes.
It's pretty interesting. So do you want to define what that is?
Well, the Mansion effect is by having an excluded home, is there an incentive, this Mansion effect, for people just to get a bigger house and a bigger house and a bigger house and actually invest in their house rather than other more productive assets.
Yeah.
So.
This was interesting because I was talking to a client of mine recently who was a property investor. They had 2 investment properties, and we talked about capital gains tax, the proposed capital gains tax. And interesting to note that he was actually in favor of it, which I thought that was actually really interesting. And he's a smart guy. So I know that he actually would have gone into some of the detail around this. So he was in favor of it, and we were just talking about, well, how would a proposed capital gains tax, if it was implemented, how would that actually affect them? And they owned 2 investment properties, which were kind of like, I call them blue chip properties in that they're quite close to the city. You could consider them a family type home. They had them as rental properties and they were renting them out. But quite comfortably, they would gladly live in them. And they always attracted families to live in because they're family type homes. So I'm just wondering. I'm guessing if there was a negative impact on property values, it would probably hit properties that were investment property type properties.
Yes, that's right.
Smaller in sort of maybe lower socioeconomic areas, dare I say, with higher rental yields.
I would expect so.
Yeah. But the Mansion effect would apply for the other ones. Right?
Exactly. So, the properties that people want to live in probably won't be too, that affected. Well, they will be, but probably
not as
a
much,
little
right?
bit more diluted. Whereas it will affect, I would think, the real investment property.
Right. Which is kind of, I guess, thinking about this logically, that would be one of the aims of this would be to make those types of properties more affordable for first-time buyers. Does that make sense?
Yes.
But on the other side, I'm just thinking about the property investors who have opted to go down the capital gains way, where they're buying properties in really nice areas that they are taking a bit of a loss. They're actually going to come out not too bad out of this, potentially.
Well, exactly.
Because they own mansions.
And also, I suppose you've still got to look at supply and demand, don't you?
That's right.
We still need more houses. People need to live somewhere.
Right. That's right.
So, we've got, structurally, that's what we've got to fix. And I'm sure your economist that was talking about the macro side.
That's right. Oh, yeah, and absolutely.
And the report even acknowledges, this isn't going to fix the housing crisis. So
you're right. So I just got to ask myself, why are we doing this? If it's not going to fix the housing crisis, if it's inefficient in addressing the inequality bit, if it's not necessarily going to increase net tax revenue after all the compliance is taken into consideration, why are we doing this?
That's a good question. Well, part of this is that they've said, well, we might look at dropping the lower tax bracket, so actually giving more back to lower income earners.
Cool. Yeah.
Although the report does note actually the most effective way of providing for those people is through tax transfers. So actually providing tax credits and assistance.
Gotcha. Yeah.
So, and this report is supposed to be not to get more revenue, but to be revenue neutral. So,
Sure.
it's saying, potentially, I think it's over 10 years, we'll get $8 billion.
Yeah. Yeah.
Purely, it's political, and it's a structural generational change.
Yeah. But from an efficiency point of view, if you're trying to move whatever it is from here to here, you want to do it as efficiently as possible with as minimal amount of leakage as possible.
That's right.
And if you're transferring wealth from this group of people and you're trying to give it to these group of people, in principle, that makes perfect sense, when we live in a world where that needs to happen. But if the government sits in the middle of that transfer, I know if I'm waiting on the phone for 2 hours with the IRD right now, I know that that's not going to be an efficient exercise. So is there a better way to do this, right?
Yeah, there's got to be. There's got to be really a better way. Well, once we add in, it's the cost and the compliance cost that I have concerns about. If it can come in and it's seamless and there are readily, information that's really readily available and it's easy for people to actually comply with this without everyone having to go off and get an accountant and a detailed tax return, because that is expensive.
Yeah.
And then we have if they get it wrong, we're then in a disputes process. That's expensive. It's stressful.
It's penalty as well.
It's
for not being
penalties
compliant.
as well.
Yeah.
And I don't want to do myself out of work, but we've got to take a practical
we're
approach.
hiring.
We've got to take a practical approach to work. And, and that's what we're suggesting. We're getting a lot of calls already saying, what do I do?
Yeah.
Well, at the moment, we're saying just do nothing. We'll hold fire.
Yeah.
But I have seen a couple of examples where transactions are, share sales, etc., are potentially going to go out to beyond 2021. And I've said to them, hold on. Let's look at this. Maybe we could see if we could change those dates, bring those dates forward.
Wow. Okay.
We're already starting to plan out to see how the rules are going to apply if they come in.
The availability of credit is starting to dry up, and that has a significant macro impact on the economy, because small to medium-sized enterprises are now not being able to fund growth.
Exactly.
It was already hard. Now it's getting very, very hard. So there's these other forces at work right now that are slowing down economic activity. And then in the wealth space, if there's more tax coming out of the wealth bit, I guess I'm just concerned that this is.
Are people going to have is there going to be spare money floating around to invest?
Correct. And what impact is that going to have?
Exactly.
So we need New Zealand to be safe for people to actually take risk.
I suppose on the flip side is what they want is investment and productive assets.
Correct. That's right.
Which comes back down to this housing.
Correct.
Housing
so full
piece.
circle, right? So let's create some equity in terms of what you're investing in,
and try and motivate people too.
Yeah.
At the end of the day, if you look at, okay, I've got a rental property or I've got a share portfolio, really the reason why people have made money on the rental property, aside from supply, demand, etc., is the fact that you've leveraged.
That's right.
And people don't often leverage on their.
No, they don't.
So that's the difference.
Leverage is the magic ingredient. It's not the asset class itself.
Exactly.
Correct. So I think that this proposed CGT will actually create more of a balanced view on how to build wealth. It won't just be so property centric. It'll be a bit more balanced, I guess.
That's right. And and I suppose to give people some comfort, you're not going to be taxed on the full gain, since if you've owned a property for 20 years, it's going to be only the gain from that valuation date.
Correct.
That comes in. So people will have a cost base on the assets that they own.
Okay.
But it's going to affect people that, as I said, that are coming to New Zealand. They'll get, the indication is they'll get a market value cost base when they become tax resident, or when their transitional residence period expires, which is this 4-year window that they have for new residents.
Okay.
But again, when people leave, the old Kiwi going on our OE, I'll go and work overseas for a few years. That's really, people are going to be really starting to think about, do they want to suddenly declare themselves a non-resident?
Because as soon as they do, then it's settling up time, right? You've got to pay the bill.
That's right. There'll be rules about temporary, how long you go away for.
Yeah.
But, one of the examples in the working group report was about, a person who went to work in Sydney and became a non-tax resident by virtue under the double tax agreement, and boom, it meant then that they couldn't have their home in Auckland as their excluded home.
Okay.
So,
oh wow, yeah.
So, and what's your realisation event? You know, change of use. Your home, you move into a rental property, or a rental property, you move in and it becomes your main home.
Yeah.
Does that event trigger a realisation?
Yeah.
And if it does, well, you could be in the situation where you've triggered the realisation, i.e. the gain, but you haven't really had the, you know, there's no third party, there's no cash in the door
Gotcha.
to pay the tax bill.
That's right. It's just an accounting thing.
It's just an accounting thing.
Line in the sand.
So
okay.
they are the sort of things we'll be thinking
Yeah.
about, and
Yeah,
they're the
yeah.
sort of things that people will need to start really planning for in, you know,
Correct.
in the next 18 months or a year. But that's only, of course, if Labor gets in.
That's right.
You know,
That's
who
right.
knows
This will
what,
be
you know, we're assuming, of course, that if a national-led government got in.
Yeah, why are we assuming that? Because is Labour
they'll
kind of just
take-
doing the grunt work and softening the blow, good cop, bad cop? You know, they could take that stance and see value in leaving it.
Maybe. You know, National's been pretty emphatic that they wouldn't keep a capital gains tax regime. They could take the opportunity to say, well,
Yeah.
you know, we'll keep it on property.
Yeah,
Or
But
limit
again,
it
it's
in some
already
way.
there with the bright line test.
Yeah,
To a
it's-
certain extent, it's kind of already there.
It is already there.
Yeah.
So,
Okay.
you know, we're already seeing it.
Yeah.
We're seeing a lot of bright line income being returned. And in fact, the most recent ones that I'm seeing is we're seeing losses.
Right. So there's actually tax credits going
There's
out.
tax losses coming through. So
Wow. Okay, so
they,
it goes
they
both
got
ways.
they got what they wanted.
That's right. Yeah. So imagine that. Imagine if there was like an incredibly, like a horrible black swan event on 2021, and the property markets just went down through the floor. Then we could bankrupt our government.
Well, they'll ring fence the losses so that you can only
okay.
use it against capital income. I imagine there'll be some ability to
Yeah.
do that.
Yeah.
But, you know, potentially
Wow. Interesting times, eh?
it's really interesting.
And I guess it just illustrates the point that and listeners might be feeling a bit anxious about this, and don't feel anxious because, again, this is just a proposal. And,
Absolutely.
And thank you, baby Jesus, for a democratically elected government, because we can choose which way we want to go. You know, if this is important to you and you want to actually make your stand for or against, that's the great thing about living in New Zealand. We actually have that power to influence this. But I think that it just tells me anyway the importance of being connected to somebody who knows how this is all working, because to me it scares me a bit. Not because I'm scared of it, it's because I'm scared about what I don't understand about all the various permutations of how this could come out of the woodwork. That's the part that scares me, because I'm not in that space like someone like yourself would be. But that's, I guess, all the more reason to be connected to an accountant who knows this and who's all over it. We didn't really go over this, Amanda, but do you want to just explain to our listeners what you do? Because I completely skipped
Sure,
that at
Darcy.
the start of the intro.
No, that's all right. Well, I'm a tax advisor.
Good, that's handy.
Funnily enough.
So it's not like you're a counselor. You're okay. This is actually what you do.
And I work at a firm called nsaTax, and we're a specialist tax advisory firm and have a chartered accountancy practice as well. And we work with clients, private clients like your listeners. We also work with accountants and lawyers whose own clients might have a particular tax issue, so we could work in with them.
That's right. I know my accountant, I think I've sent you before, my accountant has spoken to the likes of your team before, because it's beyond their pay grade, because it's quite a curly question that I'm posing.
Well, it's a bit like the GP and the specialist.
That's right, yeah.
So
yeah.
And we just sort of add the I suppose the knowledge and the technical expertise and try and solve problems.
Correct, because you'll be way more into the legislation and you'll be looking at the rulings and...
Absolutely. You know, tax is incredibly complex and it's very fiddly to get through, and it's then about taking those fiddly complex rules and actually applying them in a practical, sensible solution that's going to work for
in a way that you can communicate it quite well, because I think that's what a lot of the criticism is with some accountants, is that they know their stuff but they don't communicate well. You're really good at that. You're really good at communicating that. So what is there about that whole tax piece that you love? Like, are you quite an analytical person, or are you just curious, or what
I
is
think
there?
it's probably a combination of both, actually. The curiosity. I probably have a deep sense of fairness and justice.
Yeah, okay.
Quite like to make sure that we get the right answer.
Good.
And it is that I really enjoy that process of, people come to you like yourself, Darcy, and they're confused, they don't know what to do.
Yeah.
And it's just a case of simplifying it down and explaining what the issues are and how to get a sensible solution. Sometimes we're dealing with people and they've got themselves into a real sticky point with a dispute with the IRD, and we'll take that over and help out with that.
Yeah.
Or what I particularly like, I've got a particular interest in property.
Okay.
And so I really enjoy working with clients to plan out and come up with it's good ideas, good structuring for property transactions.
So this is going to be right up your alley then, right? So if
it will. So part of me is saying I would love these rules to come in
professionally, because it would make it quite fulfilling as well, right? The more complex it is, I guess it's more of a challenge for you.
It is. It's very challenging, but it's you get a real deep sense of satisfaction when you have a happy client and you get a good result. And and I'm not an advocate for being super aggressive. And tax avoidance, etc. The days of that have gone.
Truly, yeah.
But you can still, come up with a sensible,
like
most tax efficient structures that we can do within the bounds of the law, obviously.
That's right, and that's the difference between evasion and avoidance.
Evasion and avoidance, and do you walk through the puddle or are you walking around it?
That's right. That's right. I guess probably being a mother probably helps you with that sense of being fair and just being practical. Yeah,
it does, and part of we talk about the social justice. I've got three young boys, and again, I look at them and I go, well, how are you guys going to own your own home?
That's right.
So I'm thinking of them as well, and So
do you think that these changes would help your kids?
Note the silence.
That's right. I have noted the silence. Yes.
Yes, I think it probably will. But in terms of housing affordability, that's a big question mark. I don't know whether. I don't think capital gains tax on land itself is necessarily going to really make it that much more affordable.
Do we need more regulation to solve this problem?
I think we need bigger sewer pipes. We need more release of land.
Yeah.
It's those sorts of issues.
So that's kind of, you're almost saying less regulation or less red tape.
Well,
really.
And less red tape, better infrastructure, and I would like to see less compliance cost.
Same here, to be honest. Yeah.
For me.
Yeah, because if ultimately this is a supply and demand issue.
Yes.
So let there be more supply. Stop making the
on
argument
on the
about,
housing piece. Yes.
Yeah. Stop making the argument about the people who are just trying to do their best to build wealth, and more about increasing supply, because that'll deal with that anyway.
That's right. And I suppose we've got to also be champions for our entrepreneurs.
Yeah. Or else they'll just bugger off overseas.
They've
done it before, but I guess now they'll be taxed on the way out, right? So maybe
maybe they won't.
Maybe they won't. Man.
Yeah. Well, it's just going to be a case of making sure that the rules are not so harsh that it shuts everything down.
Correct. Not too punitive. Not too much.
Not too much.
Yeah. Okay.
So it will be interesting. We'll be watching this space in April.
Yeah.
To see where we get to. It's to me, it's going to be that whole. They'll be negotiating at the moment with New Zealand First,
That's right.
and it's really going to be see what they'll take,
and also negotiating with the public, because I know that I'm trying to be open-minded here, and I'm not trying to let my political biases creep up too much, but it's hard. But the more I'm looking at just the information, the facts, and entering into a rational debate, the more I'm centering. The more actually, I get this now. There's a lot of moving parts here.
There was a lot of pushback though when that report first came out.
I bet.
And I think people suddenly realise, it is actually going to affect me.
Correct.
And
that's right.
And other than people that don't own any assets, people suddenly had to digest it. That's right. And realise that it is actually going to affect them.
Correct. It is.
And everyone's going to take their medicine.
That's right. Everyone has to take their medicine, and it's good, because I think just to finish up on a socialist vibe. if I may. So hard for me, but I'm trying. Yeah, we all do have a duty to make sure that there is not a massive gap between the haves and the have-nots. That's the dangerous place to go if that gets too much further apart than what it is. We need to try to narrow that down as much as we possibly can in as efficient way as we possibly can, right? It's in all of our best interest, everybody. So I think we do have a duty to kind of keep on having this discussion, this dialogue. Maybe this isn't the right way to do it in its current format, but this is just the beginning of a discussion that we need to have as a country as we mature. 'Cause ultimately, we need to take care of everybody. We're all going on the same journey.
Well, it's certainly got everyone thinking and everyone talking about it.
Okay.
Exactly.
So, Amanda, if people want to find you, what's the best way for them to reach out to you?
Well, they can either find me at nsaTax, so www.nsaTax.co.nz, or alternatively, you can find me on LinkedIn, Amanda Martin.
LinkedIn is the new way of doing things,
Oh,
isn't
it's
it?
fabulous.
So
It's like Facebook for grown-ups.
That's Facebook. We all need more elbow joints. Okay, so thank you again, Amanda, for coming on the show.
Thank you, Darcy, for having me.
Really appreciate it. Until next time.